What if I told you that there's an interest rate measure that actually shows you what banks are thinking about the economy? Stick around and I'll teach you about this unique market tool and a whole lot about interest rates of all types. That measly 0.1% your bank is offering, it's not telling you the whole truth about interest rates. After my 30 years in the trenches of bond trading, I'm here to spill the beans on what nobody tells you about interest rates. By the end of this video, you'll understand how interest rates affect everything from your morning coffee to your retirement dreams, and you'll have the tools to make the smarter financial decisions. Let's dive into this fascinating world of interest rates. We're not just talking about one number here. It's a whole ecosystem of rates, each playing a crucial role in the economy and your personal finances. First up, we've got the Federal Reserve's target rate, often called the federal funds rate. Think of this as the grandpa of all rates. When the Fed speaks, everyone listens. The Fed uses this rate to influence the economy. When they want to stimulate growth, they lower it. When they want to cool down inflation, they raise it. Recently, they've shifted from raising and holding their target rate to now lowering it. So, how can you profit from Fed rate cuts? We'll get to that shortly. But here's what most people don't realize. The Fed doesn't directly control most of the rates that affect your daily life. Instead, it creates a ripple effect that influences other rates. Next up is the prime rate. No, it's not Amazon Prime's cousin. It's typically about 3% or 300 basis points above the federal funds rate and serves as a starting point for many consumer loans. Here's a pro tip. When you hear about the prime rate changing, expect your credit card rates and your home equity line of credit, your HELOC, rates to follow suit shortly after, as well as the rate on the mortgage you may be considering. Prime is a factor on all of those. Now let's go international. LIBOR, London Interbank Offered Rate, has been a key global interest rate benchmark, but due to some scandals, it's being phased out in favor of SOFR, Secured Overnight Financing Rate. Why should you care? Because these rates influence everything from student loans to complex financial derivatives. They're the behind-the-scenes players that keep the global financial system ticking. Next up, mortgage rates. These bad boys determine whether you'll be eating ramen or steak after buying your dream home. Here's what most people don't know. Mortgage rates don't move in lockstep with the Fed's rates. They move more like the 10-year Treasury yield and are set by each individual institution based on their deposits and the rates they're paying those depositors. If their depositors can get an interest rate for the same type of risk elsewhere, they've got to raise the rate on the certificate of deposit. But that also means they've got to raise the rate for the home buyer and their new mortgage. The same goes for rates offered by mortgage originators. These are companies that do nothing but issue mortgages to home buyers. These mortgages are often packaged together and sold to investors. If the rates on the mortgages aren't competitive compared to the other places those investors can invest for similar risk, they'll have to raise the rates they're offering to new home buyers. Otherwise, people won't invest in them. In a little bit, we'll discuss the best time to refinance your mortgage. Number 5, let's talk about Treasury yields. These are the interest rates on U.S. government debt, and they're crucial for understanding the economy's direction. Here's where it gets interesting. Normally, longer-term bonds have higher yields than shorter-term ones. To most folks, it makes sense to get a higher rate for taking on the additional uncertainty that more years waiting to get your money back would bring. But sometimes this relationship flips, creating what we call an inverted yield curve. This has predicted nearly every recession in the past 60 years. Typically, when the curve normalizes, it's because the economy is heading into a recession. I'll put a card on the screen for our video about how to invest when the yield curve normalizes. Next up, corporate bond rates are where companies go to borrow money and where savvy investors can find real value. These rates are typically quoted as a spread to Treasury rates. The riskier the company, the wider the spread. Here's a tidbit most people miss. Changes in these spreads can tell you a lot about the health of different sectors of the economy or that particular company. If that spread is widening, it may be an indication that that company or that sector of business is struggling. If you're finding this information as exciting as I do, and let's face it, who doesn't get a thrill from the yield curve? Hit that subscribe button. It's like compound interest for your brain. The knowledge just keeps on growing. Next up, credit card rates. Credit card rates are the party animals of the interest rate world. Always high, always ready to cause trouble for your wallet. Here's the deal. Even when the Fed lowers rates, credit card rates often stay high. Why? Well, simply put, because banks can get away with it. Understanding this can save you thousands in interest payments. Next up, savings accounts and CDs. Don't get shortchanged. Remember that measly 0.1% I mentioned earlier? Let's talk about why your savings might be losing you money. In a low interest rate environment, many savings and checking accounts offer rates below the inflation rate. This means your money is actually losing purchasing power over time. Now, let's touch on some rates that can spell financial disaster. Payday loans and title loans. These often come with eye-watering interest rates, sometimes exceeding 300% annually. Understanding how these rates work is crucial for avoiding debt traps. Always read the fine print and consider alternatives. This is the type of service you use 1 or 2 times in your life to get you out of an unexpected jam where you have no other way to get money. If you find yourself going back to these types of lenders year after year, again and again, you've got to stop, sit down, and take a hard look at how you're living on the money you're bringing in. There's a lot of finger pointing done towards these lenders. They are the last resort for people with terrible credit who have a high likelihood of not paying them back. That's why they charge these outrageous interest rates. There's a lot of discussion in the political arena about capping the interest rates for these types of borrowing. If you understand how interest rate markets work, you'll know that capping interest rates simply means that this type of borrowing will no longer be available. For the folks out there that had to use them 1 or 2 times in their life and never went back, how would their story have been different if they hadn't been able to use services like this to help them through a tough time? What I'm saying is probably angering a lot of you because you think that capping the rates will lower borrowing costs for situations like this, but these lenders will simply pack up their money and invest it somewhere else. Tell me what you think in the comments below. I'm curious how you feel about this super controversial topic. So here's something mind-bending. In some countries, including briefly in the United States, interest rates have gone negative. That's right, in places like Japan and parts of Europe, some banks charge you for keeping your money with them. Back in 2009, 2010, I was a treasury trader and actually did trade T-bills at negative yields. Our firm didn't allow retail investors to buy treasury bills, locking in a negative yield and thereby locking in an automatic loss, but we did allow institutional accounts to do that. Why would someone do that? Well, here's why. In some cases, some companies can't be long cash over a new year. So they were buying the first treasury bill to come due in the new year. There was so much demand for that particular treasury bill that it drove the interest rates negative, but they had to do something with it, and they needed that money on the other side of the year. And so you had some cases where folks actually had to take down these treasury bills knowing full well that they were taking a loss. Be on the lookout for times when this is happening. You'll want to avoid purchasing at negative rates, obviously, but you'll also want to get a sense of why it's happening. Times like these can make for difficult bond markets to find value, and they're intended to drive money into the economy and capital investment, so proceed with caution. Now let's get to the good stuff. How can you use all this interest rate knowledge to your advantage? 1. Here's a savings strategy. Don't settle for low savings account rates. Consider high-yield savings accounts, money market funds, or even short-term bonds for things like your emergency savings. 2. When interest rates are falling, consider locking in higher rates with longer-term CDs and bonds. But be cautious. If rates rise, you might miss out on better opportunities. Be sure to check out our video on how to invest when the Fed is lowering interest rates. Now let's talk about some mortgage magic. If you're a homeowner, keep an eye on the 10-year Treasury yield. When it drops significantly, it might be time to consider refinancing. With the cost and fees associated with refinancing, it can take an interest savings of 100 to 150 basis points. In other words, 1 to 1.5 percentage points to generate enough savings to justify refinancing. And the double secret bonus tip, there's no limit on how many times you can refinance. So if you're saving 100 to 150 basis points again, refinance again. With credit card rates staying high, prioritize paying off these balances first. Consider a balance transfer to a card with a 0% introductory rate if you need time to pay it off. And once you get it paid off, only use it for purchases you're going to be able to pay off when the bill comes. And the double secret bonus tip here, never make the minimum payment. Always pay at least twice that amount if you just can't spare any more. If that's your current situation, you need to get your spending and current debt payments to be more in line with your income. Number 5, bond investing. Don't just look at the interest rate. Consider the real yield, the interest rate minus inflation. This tells you your actual return in terms of purchasing power. Now for that unique market indicator I promised. Let me introduce you to the TED spread. This is the difference between the 3-month LIBOR or SOFR and 3-month Treasury bill. Why does this matter? The TED spread is like the fear gauge of the banking system. When it widens, it suggests banks are worried about lending to each other. This can be an early warning sign of economic trouble. So get a sense of where it is right now when banks don't seem to be that fearful. Then peek in on the measure from time to time to see where it is, to see if that spread widens. Here's one last pro tip from my 30 years in the trenches. Don't just look at interest rates in isolation. Watch how different rates move in relationship to each other. For example, if short-term rates are rising faster than long-term rates, it might signal that the market's expecting economic trouble ahead. Or watch the spread between treasuries and other types of bonds like munis, corporates, agencies, or taxable munis. Any widening could signal a value opportunity in that particular product, caused by something as simple as an increased supply of that type of bond. Or tightening could signal a buying opportunity in treasuries over concerns for things like the debt ceiling crisis. Remember this, interest rates are like the weather of the financial world. You can't control them, but you can sure as heck prepare for them. Here's what you can do right now. 1. Check the interest rates on your loans and savings accounts. Are you getting the best deal? 2. Understand how Fed rate changes might affect your investments and adjust accordingly. I'll put the video on investing during yield curve normalization to give you some ideas. 3. Consider how bonds might fit into your portfolio for stability, especially in turbulent times. 4. Keep an eye on the yield curve. If it inverts, it might be time to reassess your investment strategy, and when it begins to normalize, be on the lookout for possible recession because this has typically been the indicator of such. 5. Remember the global perspective. What happens in Europe or Japan can affect your portfolio here in the US. If you found this deep dive into interest rates helpful, don't forget to check out our previous videos on bond basics. It pairs perfectly with what we've discussed today. Remember, always consult with a qualified financial professional before making investment decisions. Your financial situation is unique, and what works for one investor might not work for another. Please see the description for the full disclaimer.